Hello, everyone. Welcome to our monthly webinar update. We just want to give our apologies. We had some technical problems with the live webinar software that we were using today, and that's why we could not actually do a live webinar. And so we're presenting you with a recording of the presentation. So let's get right into it. I'm joined by Matt Evans and Lorenzo Pederzani. Just a quick disclaimer. Again, what has been prepared and being presented today are Matt and Lorenzo's opinions, and they do not reflect or necessarily reflect the opinion of Industrial Alliance or Hollis Wealth. Okay, so we were all waiting for the results of the federal election. Lorenzo, why don't you give us an update on where we stand?
Perfect. Thanks, Joey. Obviously, most of us have been watching this nail biting news cycle that's been coming in this week. At this point, it is November the 5th at 2:40 in the afternoon, Pacific Standard Time, and there is still no clear winner, although it does seem as though there is a greater likelihood that Joe Biden might become president over Donald Trump. There are still a number of swing states that need to be counted at this point. However, oddly, that uncertainty has not been rattling the markets. We have seen 2 days, yesterday and today, where stock markets have been quite exuberant. Perhaps that's just a follow up from the uncertainty kind of leading into the election, but we still don't really understand what the outcome is at this point. One of the questions we often hear from clients is they want to know whether or not it matters if it's a Republican president or a Democratic president, or what happens, when one defeats the other. And so we took a look to try and find some of that data to see, what happens if a Democrat president is defeated or a Republican president is defeated. And I think the general perception is that when a Republican president is defeated and the Democrats come in, that perhaps is not as positive for the stock markets, in the sense that, Republicans have been much more prone to, tax cuts and whatnot. But the reality is that if you take a look at the data, from 1932 onwards, in the year following an election of a new president from a different party, when a Republican president has been defeated by a Democrat, the markets have up 13.2% in that year, as opposed to the other way around, when it's been a Republican that's taken over from a Democrat, where the markets are actually down almost 10% that year. That being said, I want to say that this type of analysis sometimes is a bit simplistic. There are so many things that affect the performance of an economy, of a stock market, and to just look at one variable and try and claim some kind of causation, I think can be very misleading to people. But we present the data because it's something that people often find very interesting. Related to that, people often ask us, well, what will the economy look like? What will real GDP growth look like over time? And how does that differ if the Republicans are control the White House as well as the Senate and the House, versus perhaps it's the Democrats that control all three levels, or what happens in a divided government? Well, we've seen historically that on 11% of the years from the end of the Second World War until now, the Republicans have controlled all three levels. 27% of the time, it's been the Democrats, and 2/3 of the time, their government has been divided. What this data seems to show is that actually, when the Democrats have controlled all three levels, that the markets have done better. So where GDP growth has been higher, so 4% a year as opposed to 2.8% in those other scenarios. But again, I strongly caution that this is the amount of data here is not even almost statistically significant to give a real reading. And I think people often are confusing correlation with causality, and so not something that we should read too much into, but just kind of interesting information to give kind of a probabilistic view of what might happen, if you will. But more of a kind of a roundup of what happened. When we take a look at the markets in October, we saw definitely a pullback after a few positive months. Most of that, I would say, has been driven by the fact that we've seen second and even third waves of coronavirus running through, all over the world, but in the U.S. especially, huge lockdowns that we're seeing across countries, across Europe. Oil, as a result, has taken, a bit of a beating. We saw equity markets have their worst performance since March, and we also saw bond markets perform badly. Often when things get bad in the, in the markets, bonds do poorly at the same time as equities, and that's kind of that what people talk about, the part of positive correlation. We definitely saw that happening recently. In the last 2 months, if you take a look from September 1st to October 30th, you'll see that a lot of the big names that we saw that really were causing those tech giants, the 5 big tech giants that we talk about all the time, the FANG stocks that really helped the S&P 500 grow over the course of this year, all of them had pretty significant pullbacks, including some of the banks. So definitely October was a tough month. Obviously, it's too early to tell where things are going in November, but the last 2 days have kind of started off with a bit of a bang. Matt, do you want to lead us into a little bit of how we've done in terms of the portfolio relative to the markets?
Yeah, thanks, Lorenzo. Just for new people on the line, we manage 2 portfolios, an income portfolio for our retirees and a growth-oriented portfolio for those saving for retirement. So above our performance, you'll see how we've done on a relative basis. So Canada down just shy of 9%, S&P 500, so the US stock market, top 500 liquid companies, positive on the year, up 1.2. Small cap, very familiar as well in Canada, down about 14%. International stocks down just shy of 13, and emerging markets hanging in there at about -1. So on a relative basis, you can see how we've done from January 1st to October the 30th. Our income model, which has about 50% exposure to the stock market, up positive 2.2, and our growth model with a little more equity exposure in it, up positive 5. What's interesting to note is, although October 30th wasn't too long ago, just within the last few days, as Lorenzo mentioned, the markets have moved quite a bit. And interesting enough, our growth model now, as of yesterday, not inclusive of today's rally, is up 7.7, and our income up 4.2. So where were the major winners and losers in the portfolios that we manage? So from the winners, international companies, we've used actively managed mutual fund Invesco for that portion, up an impressive 16%. And that's quite impressive when you take a look back at on the previous slide, where international markets on a year-to-date basis are still down about 13. So a massive outperformance there for Invesco international companies. One of the best performing positions for us, though, across both models, Brookfield Infrastructure Partners. This is a position we've had in our models since, I believe, 2017. It's a longstanding position. This is the second time we've trimmed the position. It sat initially at a 4% weight, grew to 6%, and we just trimmed 1% back. And that's from a very impressive move, up 50% year to date. So a big winner for us. Let's go over the losers next. Publicly traded real estate. So we use an actively traded, exchange traded fund. And you can see year to date down about 17%. What's really interesting about that is that's a collection of office, multifamily, residential, industrial, and retail real estate across Canada and the United States. And you can see real estate has been struggling, but you look at that in comparison to the private exposure we have for real estate through Rise Properties, where we have direct ownership in rental properties in the Seattle suburban region, where it's up 1.3. So this is where we're starting to add in those non-traditional or alternative assets into our portfolio to create that stability. So as you can see, well, exchange traded real estate has traded down about 17% on the year. Our appraisal-based real estate is still positive, up 1.3. So what opportunities are we seeing in the current marketplace? Because with any bout of volatility, it does bring up some opportunity. So we're going to go over 3 ideas right now.
Now, before we get to that, we always like to do polls during our live presentations. Obviously, this is not a live presentation, it's recorded, but we wanted to have some fun and put out a poll question to the group. So our question, over the last 20 years, so going back to 2000, on average, who has had better performance? So we have 3 options. Is it actively managed mutual funds? So active means that it's a human being or a team of people who are actively picking stocks and bonds, what to buy, what to sell to try to get a good return. Is it option 2, passive index ETFs? So that means index funds or exchange traded funds. Generally, it's not a human person or human manager who's picking stocks and bonds. You're just passively mirroring. You're buying whatever is in an index, and that's the performance that you're going to get. Or number 3, have they both performed relatively similarly over the last 20 years? So let's have a look at the results from that. Matt?
So in the chart here, you can see on the left, we're looking at that data that Joe mentioned over the last 20 years, and that black line is 50%. So really what that's saying is, on average, active mutual funds have trailed the passive index. So that means hiring a manager to try to outperform the S&P 500. If you can look at 2020, for example, less than 40% of active managers have outperformed the standard index. And it's obvious the reasons why. That active manager has frictional costs working against them. The management fee that they're charging, maybe the trading fee, and some taxes involved in that buying and selling of securities. So, you know, on average, you can see it's been difficult for active managers.
That being said, I think it should be important to point it out that I think there's a myth that's been propagated in the last 10 to 15 years that active management never works. We can see that is not true. 30 to 40% of the time every year, active managers are beating the index. Now, often that outperformance isn't repeatable, but a good part of the reason why our clients hire us is to seek out those active managers where we can see a history of continuous outperformance, and, you know, an attempt to pick those investments over time for them.
That's right. So on that, as you know, we are fee-based managers, so we are not compensated by any type of investment that we sell. Instead, we're compensated based on the value of your portfolio. So we will use both active and passive strategies when constructing a diversified portfolio, but often we will rely on active management, so hiring a manager in less efficient markets. It's just a fancy way of saying they're going to sift through all of the companies that are available to invest in and choose and select the best ones. Good example of that, emerging markets, international markets, like I just explained, where our active position has significantly outperformed the passive index. So we will use active management in a less efficient market. However, in an efficient market like the S&P 500, so North American large cap stocks, we will typically rely on passive management to bring down the cost of the portfolio, because that is one of the considerations we take when we're constructing these models. So this is what we're trying to say right now. The opportunity, well, if you look at the market cap weighted index, it's simply the value of all the companies that are involved. So the S&P 500, you get exposure to all 500, and they're going to have a weight based on the size of the company. So there's no oversight on diversification, and there's nobody controlling the risk. We feel that under current circumstances, you may want to consider actually switching that passive management on the S&P 500 to an active approach, because the top 5 companies in the S&P 500 now represent such a large portion of that index. If we get those names pulling back like we did last month, it can drag down the returns of the full index. So let's take a look at that on the next slide. You can see here the S&P 500. Now this information is a little dated. It's from January 1st to September the 18th. So if we look at the top 5 stocks in the S&P 500, Apple, Microsoft, Amazon, Facebook, Google. They were up about 29% from January 1st to September the 18th. If you look at the remaining 495 names that make up that index, they are down on aggregate about 3.4%. So in other words, if you didn't have exposure to those top flying names, you were probably still down year to date. And this is where we find it being a little bit dangerous. So if you're buying the S&P 500, you're really making a bet on those top 5 names continuing with their outperformance. And that's why we would tend to rely on an active manager now to sift through those valuations and see if we can continue to have exposure to those names. So for example, one of the active positions that we've utilized for that S&P 500 exposure is TD US Blue Chip. Now, this is a long-standing fund run out of the United States from a company called T. Rowe Price. And you can see here, the cost of that actively managed mutual fund is 11 times more expensive than a very low-cost Vanguard S&P 500 ETF. So most people or the media would say, well, you should buy the low-cost ETF. It's 11 times cheaper. However, if we're looking at the annualized return and the outperformance over this extended period of time, you can see TD US Blue Chip has more than doubled the return set of that passive index. So now we're not saying we always want to use that active management, but we will rely on that active management in times where we see the risk return parameters change. And I feel like we're in that kind of environment today.
Correct.
Opportunity 2, what we're showing here is the difference in international markets, so markets outside of Canada and the United States, versus the domestic market, in this case, the S&P 500. So you can see ever since the great financial crisis in 2008, both markets have taken off, but the top line, the gray line, the S&P 500 has moved significantly more than international markets. They're almost flat over that same time period. So at some point, we are going to start to see that change because historically, the two markets trade in a relatively close range. When we look at what's happening globally right now with China growing at a faster rate than most other developed nations, I think that that's going to be more pronounced moving forward. And we might actually see international stocks close that gap in valuation relative to the S&P 500. And that's just another way of showing this. We're showing the relative value of the US stocks where anything above that average line right there at 16.46 becomes more expensive. So you can see back in 2008, 2009, coming out of the financial crisis, the S&P 500 was relatively cheap. It was way down below that 16.46. And you can look at where it is today. And this is often where you get the comparison to 2001 tech market crash, where US stock valuations are hitting all-time highs. And that's what we're talking about. At some point, that trend may reverse. And there may be more value in the international markets from a relative basis.
Yeah.
All right. So time for another poll question. So given the wild year that we've had so far in 2020, our question is, what is the worst performing sector in the S&P 500 index? So again, that's the 500 largest publicly traded companies in the great USA. So of those companies, which sector has done the worst? Is it banks? Is it energy stocks? Is it office real estate companies? Or is it publicly traded restaurants? So your McDonald's, your Starbucks, KFC, Pizza Hut, so on and so forth. So we'll give you a little time.
Do we have all the mail-in ballots, Joe?
No, it looks like we've lost some votes. I'm hopeful that this poll is going to be more accurate though than the U.S. election polls. So why don't we check and see, Matt?
So third opportunity, last opportunity here. We're always looking for opportunities, like I said at the beginning. With volatility, it breeds opportunity. And you can see here, the worst performing sector in the S&P 500 has been energy, almost down 50% year to date. Airlines, hotels, resorts, cruise lines, it's no surprise that those sectors are struggling. Funny enough, if you look at restaurants, publicly traded restaurant chains, up 8% year to date. So why am I bringing up these cheap sectors? Typically, beaten up sectors eventually will recover. And one of the examples that we utilized earlier in the year was the banking sector. So Canadian banks on average traded down more than the market. So some of the bank shares, Bank of Nova Scotia, BMO, was down 48% year to date at some point in March. And we took that opportunity to structure a note for our clients within our discretionary models to take advantage of those beaten up sectors. So Lorenzo is actually going to go through those 3 notes that we created back during high bouts of volatility earlier in the year. And maybe he'll allude to the fact that we may be looking out later this year for more opportunities.
Perfect. So we'll do a quick recap here on the structured notes that we launched this year. So we've purchased 3 structured notes for clients. Again, a structured note is a bond effectively issued by an issuer in Canada. It's only the banks that do it really, where there is an underlying investment. In the case of all 3 structured notes we put together for clients this year, the underlying investment were Canadian banks. And the payouts that normally happen every 6 months are dependent on what the price of those bank stocks are at each of the 6 months intervals. And the amount of the payment is really dependent on what's going on in the market. Structured notes are particularly interesting when you're seeing a lot of volatility in a specific market or in a specific sector. When those sectors have been very beaten up, there's a lot of volatility around that area, and because of that, the price of the options on those investments spikes, and therefore we're able to put together structured notes which combine a series of options with a series of underlying investments like bank stocks to create very attractive payout patterns from a risk to return perspective. So the first note that we put together was one issued by CIBC on June 8th. This was an interesting note an opportunity that came to us very last minute from the trading desk at CIBC. And effectively, it was a note that was structured right in the depth of the financial crisis this year with COVID. And so the terms were frankly as good as anything I've ever seen in my 17 years in this business. The underlying investment was a basket of 3 Canadian stocks, BMO, TD, and Scotiabank. And how this works is there's an observation date every 6 months. If you look at the 3 potential outcomes, let's look at outcome A. If the underlying basket of those stocks at the first 6 months observation, which is December 1st of this year, is worth anywhere from 80% of what you purchased it for to 100% of what you purchased it for, a 10% coupon is paid for the 6 months. So that's a 20% annual coupon if this thing continues. In this case, when the note is essentially slightly underwater, so between 80 to 100%, you would receive a 10% coupon shortly after December 1st, and the note continues for another 6 months. Right now, that we purchased that note at a notional amount of 100. It's currently trading at 108, so the note is up 8% for clients since we purchased it in June 8th. However, the underlying basket return is slightly negative. So the most down 3.3%. So the most likely scenario, if the note would be called in the next few days, is that we would collect that 10% coupon for that 6 months, and then the note rolls over to another 6 months, which is fantastic because frankly, it'll be very difficult to replicate a note this attractive until the next major financial crisis. This is really, once in a 5 to 10 year kind of thing.
Yeah, one thing I would say there, Lorenzo, is we have basically secured an interest payment of 10% for every 6 months that the banks are trading anywhere from the price that we paid them to negative 20%.
That's right.
So it's a very attractive 20% annual coupon if that were to continue for 7 years.
Exactly. So I won't get into the rest of the features because this is not, a discussion of notes. I just wanted to give you an update on where each of the notes stood. All of our discretionary clients hold about a 5% weight in this note if you are in our models in June. The next note that we built together was our first custom note that we built with CIBC again. This one, similar, pretty much exactly the same payout structure as the first note. The only difference is we had a bit more protection on the downside where the coupon still pays as long as it's trading in that 75 to 100% range. The basket of banks was a bit bigger, 5 banks instead of 3 banks here. And again, you can see the difference, based on, the period of time. This note was issued 1 month later, and 1 month later, the rate had dropped from 10% every 6 months to 5.6% every 6 months, which is obviously a big decrease. However, in a normal environment, a remarkably attractive rate of return when you annualize that, 11% a year, given kind of the risk to return characteristics of it. This note is currently trading at 102, or almost 103, so it's up 3% since we purchased it on June 22nd. The reference basket is above water, so essentially the basket of these 5 stocks is trading at about 4% more right now than what they were worth on the issue date on June 22nd, which means scenario B is most likely what is going to happen as long as this reference basket stays positive, which means in December, we will get paid our 5.6% coupon for the 6-month period of time. And unfortunately, at that point, the note expires. But given the recent volatility we've seen in the last few days, I think we're going to be able to structure a very interesting note in December, January for clients still, which will have an attractive, return set. And then the third note that we structured for clients, we called it our growth note, but really it's really accrued coupon is probably the best way to put it. Similar feature as the last 2 notes we talked about, except on every 6 months, the amount that the coupon payment isn't paid to you, it just accrues. And that at some point down the road in the next 7 years, on one of the 6 months observation dates, when what you purchase is worth at least what you purchased it for, the note ends and you receive all of the accrued payments at once. Because of that, these type of notes pay a higher interest rate, if you will. Here it was an 8% coupon every 6 months, or 16% annually. The underlying basket was 4 Canadian banks. And effectively, right now, that basket is above water by 4%. And the current price is up about 4% on what we purchased it for. So as long as things stay the way they are, very likely in 2 months from now, well, you know what, it's hard to say. 2 months is a long period of time, but if things are where they are right now, in 2 months from now, this note will get called. You get back the money you put in plus 8%. So we're seeing potentially the 2 or 3 notes that we have are going to be called in the within the next 4 to 8 weeks effectively. So now we're starting to think about the next note that we're going to roll clients into going forward. And again, as Matt alluded to, what we're looking at is where's the volatility, where's the opportunity been, where are the options pricing going to be most attractive to structure something like this. And we can see, banks in the U.S. So this is U.S. data, to be clear. We were talking a lot about all the stuff we've talked about so far is Canadian. This is U.S. sectors, but we're going to look at both Canadian and U.S. sectors to see where there is potential to structure a note on a quality underlying asset that's going to give us an attractive payout in a reasonable time frame. And so you'll hear more about that in the coming weeks, kind of end of November, early December, as we finish our discussions with various banks right now. And that's it at this point. Normally this one we'd open it up for questions, but obviously given the nature of what happened today, that's not possible. Please reach out to us if you have any questions as always, and we will see you next month.
Thank you.
Thanks, everyone.